Opening a HELOC without running the numbers is like stepping onto a bridge without checking its load limit. It might hold and it might collapse. In this video, we're going to walk you through the exact math that you'll need to run before tapping into your equity, including a cash flow projection, interest scaling, and how to assess your payoff timeline. These are the most important factors because getting this wrong doesn't just cost you money, it can cost you your retirement.
I don't know that there is an exhausted list of number of questions you should ask. These are just some of the critical ones we pulled out. I'm going to say you can use less, you can use more, it's kind of up to you, but the bottom line is these are the ones that we kind of identified when I'm walking through whether or not this is the right product for me or for a client or for someone that I think is interested in a product like this. These are some of the questions that I ask. So critical questions to ask your lender. And it first starts with, wait a minute, why are we doing this again? Like, what is this how are we trying to apply this line of credit? Is it the goal to pay off the home? Is it to reduce debt? Are we doing velocity banking? Like, what is the full purpose and understanding of why we want a line of credit like this? And from our perspective, it's about a debt tool. It's about using a debt tool to be able to drive down debt, access your equity, and do those kind of things. So let's just revisit real quick what I mean by velocity banking. It's simply a strategy. It's a strategy designed to pay off debt, also reduce the amount of interest that you're paying to not just credit card companies, but also in relation to your mortgage in some cases. Increase your cash flow so that you can get multiple uses out of the same dollar and hopefully put that money to work elsewhere. Whether it's again, paying off your home or a secure compound interest account, or maybe it's investing externally, whatever the case may be. And again, as you move down this path, what you find is you're also putting yourself in a position where you can improve your credit as well. So it's kind of making sure we're understanding why we're getting a product like this and what is the strategy we're looking to execute. And in most cases, it's velocity banking. Because it's velocity banking is the way you're going to pay down this line of credit once it's been used. It's velocity banking that allows you to drive your income through the process so that you can cycle your income through the line of credit and then rinse and repeat, right? So I'm just jumping right in, and I'm going to zoom in on this as well because I know it's a little bit small for you, but it first starts with understanding when you walk in the door, the lender is going to attack you, right? The lender is going to come at you with a certain number of questions. So you understanding how to receive the questions being delivered is key. And the first thing to remember is this: the lender doesn't make much money off of a line of credit, and this is just a fact. And so therefore, 9 times out of 10, their objective is going to figure out how they can get you out of asking for or receiving a line of credit. Like what are the actions they can take? So the first question that's probably going to come up is, why do you want this line of credit? Like, what is the purpose of its use? Will you use what will you be using the funds for? And how much access do you need over time? Because what they're trying to do is they're trying to ask you enough questions to steer you in the direction they want you to go. And how you answer these questions are important because there's an impact. Like, they're not asking you these questions for no reason. And there are moments where we can talk ourselves out of becoming qualified for a line of credit like this. So you really want to be careful in these situations and pay close attention to, one, what's being asked and why it's being asked. And also, it's okay to ask, why are you asking me this question? Like, what is the purpose? What is the solution you're trying to achieve for asking me this question? So understanding the impact, because the impact can put you in a position where you can have better rates. Also, the line of credit could be based on how you respond. Hey, I'm looking to use this line of credit so I can go on vacation. Well, good luck with that. Or I'm looking to take access of this line of credit so that I can improve the property which they currently have the mortgage with. Or there's a business that I'm looking to open, or I've got this high credit card debt that I'm looking to eliminate. So how you respond to these questions are important because it can impact the size of line of credit. It could also impact the terms of the agreement that you have. Like, your interest rate could be directly tied to how you answer these questions. So how do you answer the questions? And I was toying with this top one because I was struggling with, what do I mean when I say be honest about velocity banking? But I had to think about it. What is velocity banking? Velocity banking is a strategy. 9 times out of 10, the lender you're talking to has no idea as to what velocity banking is. But again, velocity banking is what? A strategy designed to do what? Well, we just talked about it. It's a strategy that's designed to pay off debt. So as it relates to the first I'll call it answer, or being truthful about what velocity banking is hey, why do you want this line of credit? Because my goal is to reduce my debt. My goal is to save interest on these high interest credit cards that I'm paying, increase my cash flow. So absolutely. Being honest about velocity banking is key. It's just that be clear. Let's be clear. They may not understand what velocity banking is. So you may have to be a little bit more detailed, be a little bit more specific.
Right.
But the bottom line, I like that, right. But the bottom line is be honest about velocity banking, emphasize debt management, emphasize the fact that you understand how to use this line of credit, emphasize the fact that, you know what, you may be trusting me with a large line of credit, but I understand what it is I'm doing because I have a goal in mind or objective that I'm trying to hit. Highlight your strong payment history if you've been doing velocity banking, right? If you've been truly driving your income through a debt tool, paying debt from that debt tool, and allowing your cash flow to drive down the balance on that debt tool, your credit score should be reflecting all of these actions, which means you should be in a solid position to qualify for a line of credit like this. So highlight the fact that, you know what? Take a look at my history. Take a look at how I've been paying off this debt thus far. I'm just looking for a line of credit so that I can continue down this path. So
Jump in real quick. I'll make this quick. This is why it is so important to learn the strategy. And this is why a software is not going to help you have this conversation. Because if you say, oh, I just put it in the software and the software tells me to do that, doesn't give them a lot of confidence that you know what it is that you're doing. So this is just one more reason why one, you can learn this strategy and you need to learn the strategy. And there's no shortcuts. The shortcut is learning the strategy. Because you can apply this in a lot of different areas, especially not just in crushing debt, but also in building wealth.
Absolutely. So, yep. And to that point, I think this is a strong one. I'm sorry, not this one. This one right here is a strong one as well. And that is explain your accelerated mortgage plan. If the goal is to pay off your mortgage, which for a lot of us, the sole purpose for getting that line of credit is because I want to eliminate or reduce that mortgage that I have and get it paid off in 5 to 7 years. So if that's the goal, walk through how, because in essence, what you're doing here is you're really explaining velocity banking. Again, most lenders, most banks don't understand what that means though. And so as it relates to when you're sitting in front of that lender, understanding one, do you even offer HELOCs in my state? And the reason this is here is because there's the 49 states that we all live in, and then there's Texas. And Texas is just a little bit different. And it's not that HELOCs are not offered in Texas, it's just that Texas is different. So this is important. You know, do you offer HELOCs in my state? Because not all lenders specifically operate HELOCs in those states either. Meaning you could be at an institution that has a brick and mortar properties across all the states, meaning just use Bank of America for an example. Just because Bank of America is in all 50 states doesn't necessarily mean Bank of America will allow a home equity line of credit in the state that you're in. So asking this question is important. And do you allow HELOCs on my property type? And most people think, are we talking primary versus a rental property? But there are some states, and again, and then there's Texas. There are some states that if you have a casita on the property, will they allow you to have a line of credit just because you have another building sitting on the property? I think it's by size. You know, if it's larger than 24 by 24, you may not even be allowed to have a line of credit. So understanding your property type and where it sits and the land that it sits on, whether or not a line of credit would be allowed. And also, what would disqualify me? And again, these are questions that in truth, you're going to learn these anyway throughout the process, but I like to be upfront. And here's why. what it does is it puts you in a position of a more authoritative position, and it forces the lender to not slide information by you and be more upfront with details because you understand how this process works. So what are those things that would prevent me from being able to follow through with a process like this? And this is before you run my credit, meaning I want to know I want you to list out what those items are that could possibly disqualify me. And using our personal situation, we were caught up in the 2008 market crash where we ended up having to short sell our home. And in the process of short selling our home, we couldn't qualify for a mortgage for a certain number of years. And so there was this waiting period that we had to go through just to be able to jump back into this process. Equity access questions. And this is important because most of us, when we say, yes, I have equity in my home, we assume we can access all of it. But most banks function off LTV limits. And typically it is between 80 and 85%. I have seen banks that will do 100% LTV. And there are more banks, more than I've seen in the past. And I think it's because since we've come out of COVID, banks have been trying to a bit more eager to gain your business. I've been seeing a lot of 89%. But understanding what the LTV limits are, and also how do you determine the home's value? So asking the lender, what are the steps you take to determine how much my home is worth? Because you might have walked into that banking institution based off the Zillow estimate that you saw. So you want to understand from the banking institution, what's the process they use? Is it an AVM? Is it a drive-by? Is it a full appraisal? Is it based off the range? Meaning, depending upon the size of the line of credit you want, maybe the whether or not it's a full appraisal versus an AVM versus a drive-by is dependent upon the size that you want. So if you don't want a full appraisal done, then based off the answer to this question, you understand, hey, I need to stay within this range of what it is I'm asking for so that it stays as an AVM, an automated valuation. And again, there's no harm, to me, there's no harm in any of them, but it's just understanding the how, understanding what that process is, and knowing that information up front is key. Oh, and the maximum loan amount. Depending on how much your home is worth, depending on the size of the mortgage you already have on it, lenders may actually cap the amount of access to your equity. So maybe you do have a $5 million home, and maybe you have $4 million of equity, but the max you're able to actually access might be somewhere between $500,000 to $1 million. So, but you don't know that unless you ask those questions. And again, this is all prior to anyone running your credit. This is you asking this question up front, and it can be a bit overwhelming, but that's okay because that's their job. Their job is to provide you that information ahead of time. Did you have a question or anything, sweetheart?
No.
Okay.
No, Nathan was saying that the last lender that he spoke with told him that Zillow is pretty accurate right now compared to their earlier estimates.
Yeah, and like I said, you walking in with that information is awesome, but still, I want to know your process because you're right. And a lot of times they can do the AVM right there in front of you because in most cases, again, it's an automated evaluation of the property. It's a click of a button. So it's really simple to identify, hey, based off what I see at the moment, your property is worth X, and also calculating your potential in the HELOC. To me, this is something that you would want to do prior to even walking into the building. It's based off what you know, how much space do you have? And this is also where there's a fair amount of conversation around first versus second position, using the numbers that we see in front of you, the 400K. So this is how much the 400,000 is how much the home is worth. But the 250,000 is what's in currently first position. So what that means is this is the dollar amount that I almost said life insurance company. This is the dollar amount that the bank is most concerned with. This is the dollar amount that, hey, they want whatever you're asking for. They are not going to allow you to screw up this 30-year banking system that they have as a result of you. Because remember, you're buying them a house. There's a second house you're purchasing for them. So therefore, this is the most important item. So this is what's in first position in most cases. So when you go to a lender and you're looking for a first position home equity line of credit, in essence, what you're saying is, I am looking to replace this using the equity that I have between these two items. Well, what is that equity? Well, if we're talking 80%, 80% of 400,000 is 320K. So 80% of 400,000 is 320. So does that mean that you can get a $320,000 line of credit? In some cases, yes. In some cases, no. Because what's in first position currently is this item. So in order to be able to access anywhere close to this full dollar amount, what you're saying is I want to replace this 250,000 with this line of credit. Meaning I want to remove the mortgage that's currently in first position and put this home equity line of credit in place. Otherwise, what you're asking for is a second position home equity line of credit. And so the second position home equity line of credit is a calculation. That second position home equity line of credit is that 320K minus the 250 that you already have, and the difference between those two is the 70K. So what that's saying is, hey, I want the difference between what's currently in first position and the equity that I have, and I want access to that difference. Which one of these you want and the strategy you're wanting to use to be able to access it is very important. But you should know this walking in the door, meaning this is a calculation that you should do on your own to understand where you currently sit, where you currently fit in this process, and then walk in and let them tell you whether or not the numbers that you already have in your head are in line. And if they, for whatever reason, come up with a different number, this is where we get to peel back layers. Why? I assessed my 80% LTV at being blah. Why did you say it was something different? What is it that you're tacking on to this process that's not allowing me to access the full equity? So this is where you get to ask more questions, is my point. Long-term questions. So what's the draw period? Okay, I'm going after this line of credit, whether first or second position. How long do I have access to this line of credit? What is that term? In most cases, it's about a 10-year draw. I've seen 3-year draws. I've seen 5-year draws. I've seen 15-year draws. I've seen 30-year draws. But in most cases, I think I'm underwear, not underwear, just draws.
Yeah, keep going. Just ignore me.
But the draw period is normally 10 years.
It's a lot of draws.
A lot of draws. And the repayment period, meaning after that draw period, what happens? This says, in most cases, the repayment period, this is correct, is the difference between what your initial draw period is and the full length of a 30-year mortgage. So if the initial draw period is 10, the difference between 10 and 30 is 20. That means it's a 20-year payback period, which ultimately means it then becomes a mortgage. But there are banks out there that after the draw period, this repayment period actually becomes 30 years. So which means it becomes basically a full mortgage term for you to be able to pay back. And so the question being asked is, hey, can the HELOC be renewed after the draw period? And this is an important one. Can the HELOC be renewed after the draw period? What does that mean? Let's say I've got a 10-year draw. I've had my home equity line of credit. I'm in year 9. So I've got 1 year left. And I then go to the same banking institution and say, hey, I want to renew my line of credit. Is that possible? Or do I have to wait till the end of the draw period before I can do that? And what's the process? And in some lenders, that is true, some lenders will allow an extension with credit approval. And ultimately what that means is if you're in year 9 and the draw period is 10 years and your question is, hey, can I renew this line of credit? It's no different than just simply applying for a brand new line of credit. It's going back through the process all over again. It's going back through all of these questions all over again. But again, this is something that you should know up front before you get started. Access and usage questions. So is there a minimum? And again, and then there's Texas. Is there a minimum on the initial draw? Well, let me first step back before I beat on Texas anymore. I'll give you some insight into our own personal situation. When we got our first position home equity line of credit, we could not put anything more than the principal and interest payment that was meant to be applied I think it was the first 3 months. Meaning we could not do velocity banking for the first 90 days. The best that we could do was we could use it. We could use the maximum amount if we wanted to. We can use however much we wanted in our line of credit. But as far as any repayment, we could only pay the principal and interest payment for the first 90 days. Peel that back a little bit.
Yeah, why?
So it's a line of credit, and banks realize they don't make much on lines of credit. And we'll dig into some of that as I scroll down here. But what they're focused on is how can they recoup this money that they've spent, right? And so if they only allow you to input or apply the principal interest payments for the first 90 days, that means that remaining balance is building interest over those 90 days. This gives them an interest bucket. So now they have at least got 90 days of high interest off you. So they can recoup some of those dollars that they've put forth through this process, because this is not a mortgage. This is far from a mortgage. And so this is one of their, I'll call it, opportunities to make some of that money back. And in our situation, the minute that 90-day hit, I took everything that we had in savings, dumped it onto the line of credit, which immediately dropped the balance on the line of credit, which means I'm paying the minimum amount of interest at that point. So again, I understand how to play the game, but in some cases they handcuff you. So understanding up front, is there a minimum on the initial draw? Now back to Texas. Texas, the only way you can get money out of a line of credit is it has to be in increments of $4,000. Meaning it's not as simple as I just want to pay bills from my line of credit. Like there's a whole process you have to put in play. And again, I don't know that this is 100% across Texas. I don't know that. But I know the banks that I've dealt with, the PNCs, the banks that I've dealt with in Texas, it is exactly like that for whatever reason. And how can I access my funds? We talk about this a lot. And we talk about it in the form of, just because you have a line of credit as a debt tool doesn't necessarily mean it functions as a debt tool. So how can I access my funds? Do I have a checkbook that comes with the line of credit? Is there a debit card? Can I do online transfers? Can I link it to my checking account for overdraft protection? So again, how you're able to access the funds matter. And this is important because whether or not this is a revolving line of credit says, can you get multiple uses out of the same dollar? Can you exit money from the line of credit, pay down whatever the debt is, use velocity banking, drive the balance back down, and then recycle those funds over and over and over again? Or can you just use the funds in at one time? Meaning, is this a true line of credit or is this a HELOC, not a HELOC? So again, this is important. This is where, for those lenders who are just trying to get you into a product and get you into a product that they actually deem necessary because of the commission that they make, or it's a product that they're pushing today, asking these questions allow you to peel back the layers without being confrontational. This is just you asking, hey, is this a revolving line of credit? And once they say no, or once they say yes, now ask more questions and continue peeling the layers back.